What kind of growth are we going to need to see to support the valuations that we are now seeing in major equity markets?
Well, there are two issues really going on with the equity valuation. One is the numerator, which is what the earnings are expected to be. And of course, the other issue is what the expectations are for the denominator, meaning interest rates. Both of these are important components when we think about what equity prices make sense. And although the earnings on the top line look like they're maybe going to be a little bit stronger going in Europe, the denominator is a question mark, especially when we put it in the context of global interest rates. And that's where we really have a little bit more of a concern that the market is perhaps a little bit priced too high, given what expectations are for overnight policy rates going forward.
What's the biggest misprice?
What's the biggest misprice? Meaning the U.S. or Europe?
Yeah, whichever where you see the equity valuations versus growth, where's the biggest disconnect?
Oh, the disconnect is with alternative instruments. I mean, we're going to be seeing interest rates rising with the policy rates going forward, particularly in the United States. And what we see at the end of the projection period, which is 2018, we see a gap of 150 basis points between what the market expects the overnight interest rate to be in the U.S. and what it is in Europe. And that's going to play out in the form of exchange rate changes or in the form of snapback of some or the other prices. And so equities are going to be caught up in that turmoil.
For the U.S. growth forecast, you have 2.1% for 2017 and 2.4% for 2018. How did you factor in D.C. and fiscal policy into that call?
So we had a more aggressive approach to factoring in fiscal policy in our last projection. And of course, some of the numbers came in a little bit weaker than we thought, and that took down 2017. But it's also the case that our expectations for movements on both the fiscal spending side as well as on the tax side, those have moved out into late 2018. So in some sense, we're looking at the projections that we have more robustness on the investment side, the real investment side, and don't depend too much yet on action in Washington.